Well, the broader markets have succumbed to pressure. They are in the red, but it is the Nifty which is actually taking a breath away with the kind of move that it is witnessing. 26,230 right now, I think at the highest point of the trading session. So that 3 p.m. move really taking place in the last 15 minutes or so. It's Maruti, Grasim, Tata Motors, M&M. So autos clearly chugging along very, very nicely. And they are the ones which are sitting at record high levels. At least a lot of consequence as well as the entire Nifty auto at the moment. In terms of the contributors, M&M is contributing the most, followed by Maruti and Tata Motors, but ICICI Bank and ITC is also not far behind. On the losing side, ONGC, L&T, Cipla, NTPC, these are the spoil sports right now, but definitely great traction in the market right now. We do have Ajay Bagga staying on with us. Nuresh as well as Kunal are with us, and Sandip Sabharwal also joins us on the show. Sandip, to begin with, this massive rally which is underway in auto, completely undoes what we were saying a couple of weeks ago, the inventory build-up and the fact that there was a lot of discounting and all of those clamors which were coming through. What do you make of the auto sector right now?
Anisha, so when we were discussing the industry at that time, so the two-wheeler stocks were running up and the four-wheelers were correcting. And what I had said was that in anticipation of festival demand, it's likely that the four-wheelers will also see some sort of revival going forward. Now the challenge, or let's say, what now it's a question of delivery. Now these companies have to deliver on the festival season sales, and I think that's the challenge. So if festival season sales pick up, then I think these stocks could sustain. If not, then I think they could give up the gains. So within these companies also, if you look at a company like M&M, so they could actually benefit from farm sector revival, and the tractor segment, etc., could do better, and that's always been a high margin business for them. And this has been one company which is largely underappreciated because you look at the kind of models or vehicles they launch and the numbers which become successful and the kind of waiting list which build up. No other auto company in India is able to do that on the four-wheeler side. But still, in terms of valuation, it tends to trade lower than other auto companies. So I think that some catch up is happening out there.
Yeah, absolutely. And talking about catch up, I think the kind of move that you're seeing in some of the Nifty entrants, that's also been remarkable. In fact, Samit is here to tell us all about the likes of Trent and Bharat Electronics, which are all set to replace Divi's and LTI Mindtree in the index.
Well, the NSE index changes will be implemented from September 30th, that is Monday. But major inflows regarding this is expected to happen on September 27th. Now, a couple of stocks that are getting that are the new entry in the Nifty 50 index, that is Trent and BL, and both the stocks will see an inflow of anywhere between 340 to 470 million US dollars on the back of getting included in the Nifty 50 index. While two stocks that is getting out, that is Divi's Lab and LTI Mindtree, could see an outflow of anywhere between 150 to 190 million US dollars. Now, there are a host of changes when it comes to the Nifty Next 50. 5 stocks that are getting included are BHEL, JSW Energy, Macrotech, NHPC and Union Bank, and the inflows in these stocks could be anywhere between 30 to 50 million US dollars, while 5 stocks that are moving out of the index are Colgate, SRF, Marico, SBI Card and Berger Paints, and these stocks could see an outflow of anywhere between 20 to 57 million US dollars. Now, one change when it comes to the Nifty Bank Index, Canara Bank is coming in while Bandhan Bank is moving out. Canara Bank could see an inflow of close to 44 million US dollars, while Bandhan Bank could see an outflow of close to 37 million US dollars. Now, apart from this, there are some changes when it comes to the CPSE index as well. In that, NTPC's weight is expected to come down, because of which there could be an outflow of close to 132 million US dollars, while 3 stocks which could see an increase in the weightage are BEL, Coal India and ONGC, and these 3 stocks could see an additional inflow of close to 29 to 30 million US dollars. So keep an eye out for these stocks in trade. September 27th is the date when flows are expected to come in on the back of changes in weightage or changes in the index, NSE index.
Okay, we will watch out for the new entrants as well as the flow picture coming in. And Ajay, just before we let you go, a quick question on the power sector, because this new electricity plan has us excited with the 9 lakh crore capex coming in. Do you think this was priced in already, or do you expect further fireworks for the power stocks?
It's largely priced in. Every 10 days we get this REC number of 2030. They will be at X lakh crores and renewables will be this high. So largely priced in already. But power, again, it dovetails into the artificial intelligence, data centers, power demand picking up, and the renewable story as well. So the shovels and the picks providers as well as the financiers will tend to do well, but it's a well-known story. And just one more point I would like to add to what my friend Sandip was mentioning. And again, as I mentioned earlier, I was surprised with the run-up in the passenger vehicle numbers given the inventory build-outs. If you look at top-down, the diesel consumption in India is down 2.5% year on year. The SUVs are getting huge discounts. They are not selling. The MUVs are selling more. So the smaller cars, which are petrol driven or hybrids, of course, are getting subsidies. They are selling. But the diesel cars are finding it difficult. So I'm not very sure on the passenger vehicles. I would totally agree with Sandeep's thesis on that. And maybe the two-wheelers and the rural connected autos will do much better.
Rajesh, so good having you on the show and join in with your thoughts. But Sandeep, I want to talk about Trent. This morning, you've got a city initiation. Of course, the stock will make its way into the index, and we've seen the kind of inflows that have happened. But now they've put a lofty target of 92.50 on Trent.
So whenever you do such a late initiation, in order to justify a buy recommendation, you have to give a target price at least 15-20% higher. So I think it germinates from that. So the key is that Trent has been surprising all of us with the kind of profit numbers they've been generating quarter on quarter. And if this surprise continues the way they've been surprising, then this target might also be possible. But as some of the business models get more established, growing at that pace could be challenging. So I think it will be interesting to watch how they deliver, because on pure valuations, even this price of 7,800 is very, very steep.
The price is steep indeed, but it's just that there are a lot of participants who still love that stock pretty much. Just taking stock of the underperformance coming in from the broader markets. And Naresh, what do you make of it? Nifty is making fresh records high, 26,200 scale comfortably, but there is no sort of reviving the mid cap and the small cap indices today.
See, over the last 1.5 years, it has been mid cap and small caps outperforming the Nifty, Bank Nifty by a very big margin. So a few days, few weeks where Nifty and Bank Nifty take a lead is pretty normal. And also today is an expiry day. There are some flows, rejects, etc., which continues. So that could be one of the reasons the flows are more centered towards the large caps. But overall, it's a good thing to have the benchmark indices do well and the small caps to take a little bit of a pause or get more selective. And that is the structure right now. And it's been 1.5 years of small cap. So if we get a 1.5 week for Nifty, it's still a normal time.
Take coming in as far as the underperformance of broader market is concerned. But Sandeep, I wanted your take regarding what should be the right portfolio allocation at the moment. Because on one hand, of course, you have equities which are looking a bit toppish. Gold has run up more than Nifty this year already. Bonds is, of course, is also very precariously placed with the entire rate cycle turning. Within the portfolio allocation level, what would be the efficient allocation as per you?
So I think portfolio allocation varies from person to person and the age group which they are in, etc. So it's very tough to generalize. But it's been my view that for people who are not in, let's say, who don't stay in the US and their currency is the reserve currency, gold has always been a very good investment, and it's been something which has been negated by many people. But it's today one of the biggest sources of wealth for Indians. As per current calculations which I did on 29,000 tons of gold which Indians hold, it's almost reaching 75% of the country's GDP, the kind of gold which people hold at the current prices. and it's pure currency in a way that it can be easily encashed at any point of time. So gold should definitely be part of the asset allocation, maybe 10 to 15%. Bonds and debt depends on person to person. So I think it's tough to define, but everyone should have at least 1 years of expenditure and some additional amount in fixed income and bonds to take care of your need. If you cannot pull out of, let's say, risky assets, and you at least have that money stored. So I think that much people should have. Then it depends on whether you're conservative, aggressive.
Quite interesting. And, Sandeep, like you're rightly pointing out, that's going to completely depend on, what your preferences, goals, etc., and capacity is. But this investment in gold as well as fixed income that you're advising right now, it's because equities are getting toppish, or it's because both fixed income and gold look attractive?
No, in general, because in any case, I think gold should do well only. And if you see the 29% return which we are seeing is despite the kind of import duty cut which the government did. Otherwise, the rupee returns for this year without that import duty could have been 36, 37%, nearly double that of the Nifty. So each asset has its own cycle, and to that extent, to play that cyclicality, it's always better to have some diversification.
Taken, so gold is expected to do well from here on as well. Let's do a quick chart check as well before we move forward. Kunal, would you still anticipate a solid upside despite that 30% move on gold this year? And what about crude also, if you're tracking that? Because of course today there has been a 2 to 3% dip because of the comments that we got from Saudi Arabia that they're not looking at holding on to that $100 internal target that they'd sent for crude.
So gold specifically, yes, I would be very bullish on the asset class even at current levels. And I think this 30% YTD gain is, it was a very meager kind of a price action which happened for gold in the previous year, where it moved, I think, around 12%, 13% from 1900 towards 2000, 2060 plus in terms of dollar denominated prices. And the major chunk of the move which has happened for gold prices has happened in the mid part of this last 8-9 months for this calendar year. And I believe that what we are seeing right now is just a momentum and as well as a follow through inertia for the gold prices. But then the kind of breakouts, the kind of stability the prices have shown after that mid part of the move, I think is one of the major reasons why I would probably believe that there could be lack of volatility and more consistent price uptrend. So I think from current levels of 2650, 60 approximately on dollar denominated prices, I would probably expect gold to come back towards 2665, 2700 kind of a mark on those terms.
Okay, that's that. In fact, I don't know if we can bring up that soundbite of Chris Wood as well, because he also made the point that in the very near term, that's the next 6 months, he also finds the gold mining stocks to be most attractive. In fact, we will, play that soundbite up for you in just about a few seconds from now. I think we can cut to it.
I believe the inventory in the top 7 cities is in a multi-year low. So what should happen is that the property recovery should gradually broaden out in terms of it's been led by the high end. Basically, the amount of properties being bought in India is still very low, what we've seen in China at the peak. So I think from right now, I think we should hope that the property cycle can run another 4 years. We're just entered in the fourth year of this upturn. The drivers of this current bull market we've been in have been more in the energy, infrastructure, real estate area, and my guess is that these remain the key drivers of the story. 6 months I would be owning gold mining stocks. Gold has gone up a lot. Energy is at the bottom end of the range. Profit margins of gold mining companies should increase significantly, and so far gold mining stocks have been underperforming gold bullion. Now, my long-term recommendation to anybody listening would be to sell US Treasury bonds. The banks are overdue some outperformance. The banks have also had a bit of a regulatory headwind because the RBI has been quite preemptive in terms of regulatory initiatives in recent months. which in the short term is negative for the banks, but in the long run it should hopefully be positive because it means that the credit cycle should be maintained for longer without disruption. So I'm maintaining banks in my greed and fear India long only portfolio.
That's the latest coming in from Chris Wood. But Sandeep, also wanted your take regarding the disparity of move between the large cap and the small cap. And I'm not talking stock specific right now. Assume you are a mutual fund investor. Would you want to put a lump sum right now into the large cap or the Nifty Bank ETF itself, or would you continue putting your SIPs etc. into the small cap? Are you anticipating a bit of a shift there?
So I would not put lump sum anywhere today. So lump sum is out of the picture given the current move and the valuations. But I think on whoever is doing SIP, there's no reason for them to stop investing on a regular basis, even in small and mid caps. Now the question becomes that whether you are doing it in an index or whether you are doing it in a specific portfolio. So if someone is doing mutual fund SIPs, I think the lower cost option for them, at least small and mid caps, is to do in the index rather than actively managed funds, because most actively managed mid cap funds have not been able to outperform.
Very true. Yeah, that's been very true, at least. While one always, feels like putting it in the mutual fund, it's the index, at least the mid cap and the small cap, which has managed to beat the expectations or managed to outperform any of those individual portfolios. Quick stock of what's happening in the market. Kalyan Jewelers, KFin, Crompton, Saregama, Concord Biotech, these are all in the red. Even First Source, for that matter, is in the red right now. What's in the green is Maruti. What's in the green is Blue Star, Analco, SAIL, NMDC. In fact, metals is the pack, Sandeep. Would you buy afresh in any of the names, or even, let's say, a basket of some of these metal companies?
Typically in metals, what we say is that as the cycle bottoms, as the metal prices bottom, that's the time to buy. But then this time, the dichotomy is so high that many of these metal stocks are actually more near 52-week highs. When today in the papers we read that steel prices are at 4-year lows. So even if there is some small revival in commodity prices, etc., I think it's already built into these stocks. Now, a major reason for the recent move has been the Chinese stimulus. Now, the Chinese stimulus, I think, does more to revive their stock market rather than create any improvement in the real economy. So I would be very surprised if commodity prices move up sharply from current levels. And as such, I would think that for many people who are actually holding commodity stock, this could be a good exit time.
Right. Okay, that's the take coming in on metals right now. In the meantime, just want to revisit that auto theme because autos definitely are charged up ahead. Maruti, M&M, Tata Motors, all looking very smart. You've got metals like we've been flagging off. That's looking very smart indeed. But on the flip side, there's a Cipla, there's Hero MotoCorp, HDFC Bank is flat, ICICI Bank has not done a whole lot today. Reliance, Bharti, these are some of the stories which are still lying quiet. Sandeep, we've often discussed the pharma revival, but does it seem like it may have more legs to go?
So one leg of sharp up move in pharma has already happened, driven by much better than expected delivery of profits, which a majority of the pharma companies gave in the last few quarters. And as such, that's led to the re-rating what we've seen in the recent past. And plus the input costs were moderate, so that led to margin improvement also. So I think a large part of that, like for a majority of the market, is already in the price now. So from here on, for these stocks to do better, now it will be individual stock-wise movements, but for them to do well, I think we need to see decent sales revival as well as maintenance of margins.
Okay, so time now to take some BTST trades if we haven't done that so far. Naresh, what's the BTST trade?
First is a buy on Ultratech Cement, close to making a new 52-week high, stop loss at 11,800, target price of 12,400. Second is a buy on AB Capital, about to cross the recent swing high, stop loss at 232, target price of 242.
Kunal, what about your BTST trades?
So I'll go with the one M&M Finance. That's a chart which is looking attractive, confirming a swing breakout, raising the targets higher, which I had given in the morning. So targets of 350, stop loss could be trailed to 330. And AB Capital is a buy, targets of 250, stop loss could be kept at 228.
Right, okay, Sandeep, Kunal, Naresh, we'll let you all go on that note. Thanks as always for joining in.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.